Stock markets find a lifeline. It is a tepid one, but a lifeline nevertheless. Looking at the first up day for U.S. equity markets in quite a while here. If we're looking at the NASDAQ, of course, last week was a brutal fourth week in a sell-off. For the S&P, a brutal third week. In fact, all three of the major indices, and if you include the Russell, all four, have been sinking quickly and found a little bit of a respite today. For the NASDAQ, it was the first bounce in 4 days. For the S&P, the first bounce in 6. So some signs of life here, but does this move have legs? That's what we're going to be asking ourselves here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to look through the bit of event risk that is in front of us here. There's a little bit of scattered economic data on the calendar, but the main question that we're going to ask ourselves is going to be a bigger one. And that is this the place where stocks are going to try to find a bottom? And there, the question is a bit more macro, a bit bigger picture than just looking at individual data releases, than looking at the sort of ins and outs of what those numbers are likely to be and how they might influence markets, because there is a bigger story arc that seems to be at work here. And that's really what we're going to focus on as we proceed. So we'll take a look at the data. We'll take a look at what it means and use that to set us up for this larger conversation, and then sort of see what that means for the markets and how to trade them going forward. So the first piece of notable data here is going to be the flash set of April Purchasing Manager Index PMI numbers from the major economies. Flash means just that this is the first estimate. Typically, this covers the overwhelming majority of the PMI surveys. They then get revised about a week and a half later. Those revisions are usually not material. So this is really the market moving set of numbers, usually. And what this does is it gives us a much better perspective on the business cycle in these major economies than do GDP numbers, which tend to be very, very late. They tend to come out well after the sort of period of relevance for markets has passed, at least in the near term. So this tends to be much more timely indication of where GDP is headed versus GDP itself. And of course, we'll get to GDP because that's also on the menu this week. But let's begin here first with the PMIs. And the focus really first is the Eurozone, the UK, and the US. I would argue the US is primarily in focus because, of course, the main question that has really defined the price action for financial markets has been, where is the cost of borrowing going? And as we've looked at, and we'll just remind ourselves here again, the main impetus for risk appetite in these markets has been the degree to which there is cheaper money in the future versus more expensive money in the future, and the extent to which that shapes people's desire to either take market risk or avoid it. So we can see that when this rally starts in late October, early November of last year. And of course, if you've watched Macro Money, you've seen this chart a gazillion times, so we'll just review it very quickly. When this rally starts, what you have is the start of the build out in Fed rate cut expectations, because at the November 1 policy meeting, the Fed very directly, very pointedly signals we're done raising rates. The next move is down. They don't quantify that until late December, so the markets kind of run away with it. And you can see that come the turn of the year, they're looking for 6 cuts, 1.5% in easing, or 150 basis points. In late December, the Fed establishes this baseline and says, we think we're going to cut 75 basis points or 3 times in 2024. As you move through the beginning of the year, what you see is that U.S. economic data starts performing better than expected, and so the scope for those cuts starts to shrink. But the key thing for equity markets is that until you get really into the middle of March, what you see is that there is still a dovish tilt. So there are more cuts that the markets are anticipating than what the Fed baseline sets. And that holds until you get into March and the Fed reinforces this idea that they're going to do 75 basis points. The December and March forecasts are exactly the same, even as it upgrades growth and inflation forecasts to give us some sort of recognition that, yes, indeed, the data is improving here. And so it is not until we get to here that the markets go, right, okay, now we feel the Fed is late. And so as this data continues to shift, and from then we'll get some more hotter than expected CPI numbers and so forth, these rate cuts keep diminishing. And what this then means is that if you are taking bets in markets, if you're deploying risk capital and you're wrong, then you're going to have to replenish your capital by borrowing back more expensive than what the Fed is anticipating. So in relative terms, the markets go to the hawkish side of Fed policy expectations. And that, as we can see here, short circuits risk sentiment in short order. And you start getting liquidation. Stocks fall hard. So it is through this lens that we're watching what is going to happen to markets this week. Going back to this PMI data. For the US, we can see here relatively little change. The manufacturing side of things expected to basically remain unchanged, 51.9 for the March number, 52 expected for this one. Services, not much different, 51.7 versus 52, not exactly the world's most dramatic change. That might get the composite nudging up to 52.2 maybe, something like that. But there doesn't seem to be a significant sort of deviation here. And we can see when we look at the way that this has developed is there was something of a bottom in manufacturing established in December. Come January, we kind of leveled up to about a 52 reading on the composite as manufacturing here returned to growth. As ever, this is in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What you see here is we haven't really gone anywhere in 4 months. We clearly leveled up between what we saw in, let's call it, the second half of last year, and we can sort of very clearly see that on the chart here, if we look at the average for the composite PMI for the second half of last year, it averages to about 50.7. And that's because there was a relatively strong July. If we look August through December, where there was a clear kind of step down in growth, the average is closer to 50.5, so near standstill. The average in the first 3 months of this year has been 52.2, and that's about, it looks like, where we're going to land for the April number here, if these expectations hold relatively as this suggests. And so it's not as if we're getting meaningful acceleration. It's not deceleration. But the question, of course, from a Fed policy expectations perspective is, does this change the calculus in any way? Ostensibly, no. However, the differences for the Eurozone and the UK seem to be more considerable. So although in the UK, for example, the manufacturing numbers are expected to hold relatively unchanged, and the service sector numbers are expected to hold relatively unchanged, so the composite probably holds relatively unchanged as well, give or take. For the Eurozone, meaningful improvements are perhaps on the menu. Much more significant than anything that we're seeing out of either the US or the UK, and that ostensibly comes from a slower pace of decline in manufacturing, still under 50, but at a slower rate is the contraction that's being telegraphed here. But services seen with quite a meaningful acceleration here. And so when we compare what that means for relative policy expectations, maybe that gives room for the increasing disparity between Fed expectations and those for the Bank of England and to some extent the ECB to even out a little bit, to narrow some. So the ECB now expected to cut 73 basis points this year. That's almost 3 cuts to the Fed's 1, maybe 2, what the market's baking in now, which is 33 basis points, as we just saw. For the UK, it's about 54 basis points, so 2 cuts. Maybe that means that the UK has less scope for adjustment because the PMIs move less. But if the overall message here is nothing has really changed, well, then maybe the pound doesn't do a whole lot, but the euro could have some room to correct higher. And in general, as long as this doesn't move the needle particularly far for the US, maybe much of what has been the motivation for the dollar to rally around Fed rate cut expectations fading, maybe that's spent here. After the PMIs, as promised, GDP. Here, we're looking for a bit of a slowdown as well. The annualized growth rate seen coming down to 2.5%. If we kind of compare that with where we were, it's a fairly significant step down from the prior quarter. 3.4% was where we registered for the fourth quarter of last year. 4.9 was the third quarter, so very significant acceleration there. A step down to 2.5%, not unreasonable given what we've seen. And again, it seems like what we would need to see is a really meaningful upside surprise on this to change the Fed calculus. This is probably the place where such a thing is likeliest to appear because, as we just saw from the PMIs, we'll take a look back at them right here. We can see the fourth quarter was meaningfully soggier than the first. So perhaps in the first quarter, we'll see slightly better outcomes. Perhaps we won't quite see the pullback that's envisioned here. And maybe that gives a little bit of a pushback on sentiment. Maybe that, again, nudges stocks. But this doesn't come out until Thursday. So between the start of the week and these GDP numbers, there's lots and lots of room for the markets to say, well, what's really going to change the calculus here now? There's a Fed meeting on May 1st. The Fed is not talking for the week before the meeting. That's this week. And so, what is really going to give stocks such a shock, given that they've been motivated, it would seem, by these Fed policy expectations, to really keep the sell-off going without fresh fodder? And maybe this GDP number could be that fresh fodder. But again, as we just saw, U.S. economic data relative to expectations has anchored a little. In fact, it's dipped back below the 20-day moving average for this city economic surprise index, which is about a month average. This is daily data. There's about 20 days, give or take, that go into a month, 20 business days on which we have data, 5 days, about 4 weeks in a month. So that we've slipped below what is essentially the month, the running month average for this seems to suggest maybe there's something a little bit soggier that's on the menu here. If that extends into the GDP report, and this actually comes in, let's call it in line or a little bit worse than expected, again, maybe fodder for something of a lifeline for stocks. Maybe a little bit of a knockback for the US dollar as the markets edge away from some of the speculative, hawkish speculative now, extremities that we've seen. It should be noted, I think, that we haven't really moved very far on the Fed outlook recently. So we, of course, made that very important level shift from baking in something like 54, 55 basis points on the year for the Fed as of, let's call it April the 8th, April the 9th. Then we get that hotter than expected CPI data, and we shift to about 33. That's where we are now. We have essentially not moved on this in about a week and a half. So if there was an opportunity for perhaps some profit taking, some retracement, this week might be the week before we get into the Fed itself. And as long as the data complies, by which I mean it doesn't come in any meaningfully hotter than is expected, maybe we get that occurring here. And then, of course, on Friday is the PCE inflation number. This is the Fed's favorite inflation gauge. Expectation here is that we're going to get the core reading, which is what the Fed cares about the most, and the headline coming in exactly in line with each other, 2.6% year on year. That would be a little bit of a pickup for the headline and a little bit of a downtick from the prior for the core. That core is what the Fed really cares about because that's where the remainder of sticky inflation is trapped. But again, not much of a newsworthy release here, perhaps. With the CPI and the PPI numbers already out, calculating what the PCE is likely to be is relatively simple. And so these forecasts are probably pretty good. So a significant deviation seems unlikely. And as ever, it is that Fed calculus that needs to change in order for the risk sentiment backdrop for markets to change in a lasting way. And so if that calculus doesn't change, if we are still in this world here, where the Fed is at 75 basis points, the market is already at 33, we haven't really moved from 33 in about a week and a half, what is going to come out from this data that is going to meaningfully upset markets further beyond where they've gone already? Well, maybe not very much. So perhaps this is an opportunity for stocks to bounce a bit, for the dollar to pull back a bit. Not to say that the trend lower has been arrested. That seems unlikely at this point, at least. But a bit of a corrective bounce seems like it could be on the menu. And then, of course, we refocus on the Fed next week, which seems likely to, given Fed speak up until the blackout this week, already begins to take the shift to a more hawkish rhetoric. We heard it from Jay Powell even as recently as last week. If that echoes into the Fed policy announcement, well, back into the sell-off we probably go. But between then and now, Fed meetings next Wednesday, we might have a bit of a digestive period here. And as long as the data doesn't upset markets further, we might see something of a risk on dynamic develop here, even correctively so. And that is macro money for today. Thanks very much for joining as ever. We are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what that might mean going forward. I'm back on with Chris for Futures Power Hour on Fridays. I am on with Tom and Victor for First Call on Sundays. Also on with Victor for The Price of Truth on Wednesdays. Definitely check that new show out. I'm writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.